Hi, in this video we'll talk about dilutive securities and earnings per share, and I think for this video we'll focus on how to account for dilutive securities. So dilutive securities are any type of securities that can dilute the ownership in the corporation's common stock. And here's an outline. We will not be able to cover all of this in one video. We'll see how far we can get. First dilutive security is convertible debt. These are bonds which can be exchanged for common stock at some kind of ratio. It could be 1 for 1, or it could be 1 for 12, or 1 for 15, whatever. But each bond can be converted into a certain number of common shares. So it's great. It has the benefit of being a bond. You guaranteed interest payments and principal payment with the privilege of exchanging it for the company stock. So if the company starts doing very well, you might just trade in for stock. How do we account for it? Well, at the time of issuance, we're just going to record it as we would any other type of bond. The reason is that we can't really separate the conversion feature from the bond itself. Okay, so we're going to record it the same way. So as an illustration, we have Miller Corporation issuing $4 million par value, 7% convertible bonds at 99 for cash. If the bonds did not include this conversion feature, they would have sold for 95. So they clearly tell us essentially what the conversion feature is worth. But again, we don't care about that. They're just trying to throw us off there. We're not going to try to separate that conversion feature and account for that separately. We're just going to account for it the normal way, as if it wasn't convertible. So the way we do it, look, this is the amount of money we get issuing at 99. So obviously it's issued at a discount. And here is the journal entry there. So it's the same way as if it was not convertible. When we actually convert it, so when the bondholders decide to convert some of their bonds into common stock, we're going to use the book value method, no gains or losses upon conversion. Why is that? Well, we don't record gains or losses on transactions with shareholders. And this, because they're becoming shareholders, this would be a transaction with shareholders, much like treasury stock. So, Moore Corporation has outstanding 2,000 bonds, $1,000 face value. Each is convertible into 50 shares of $10 par value common stock. So 2,000 bonds, each one of these things can be traded for 50 shares. The bonds are converted on this day when the unamortized discount is currently $30,000 and the market price of the stock is $21 per share. Okay. So here's what we're going to do. So conceptually, guys, when you convert it, think of the balance sheet. Pretty clear then that your liabilities are going down and your equity is going up. And that's exactly what we're going to do. You see bonds payable goes down by $2 million. That's just the 2,000 times $1,000 face value. Also, your discount goes away. So you want to credit that discount. Your equity goes up. You're going to credit common stock for, remember you had 2,000 of those bonds. Each one of them can be traded for 50 shares, and each share is a par value of $10. Okay, and the remainder, of course, is your paid-in capital in excess of par hyphen common stock. And you just sort of back solve for that last one. All right, so it doesn't matter what the current market price of the stock is. They do give you that information. But as you can see, we don't use that in our accounting for it because we're not going to have a gain or loss on the transaction. Another thing is induced conversion. So whenever the bondholders convert, that's their option. It's up to them. The company can induce them, though. They can give them some encouragement, if you will, some incentive to convert. Why would they do that? Well, maybe they're concerned about their debt ratios. They want to lower their debt. So they may offer additional consideration called a sweetener. If they do that, that's considered an expense. If you give them essentially if you pay them money to convert, that's an expense. Okay. If you do use a sweetener, when you do the conversion, the accounting is exactly the same. The only difference is before this transaction, you would have an expense of $70,000 in this case for your sweetener, and it would be called debt conversion expense. Okay, then we have retirement of convertible debt. It's exactly the same as retiring debt that doesn't have the conversion feature, so that's no different there.